Hello everyone, welcome back to this 11th lecture of the special series of Crash Course Economy 2022. So in this video, we'll be looking at the concept of Prompt Corrective Action Framework by RBI and all the corresponding important updates. In the previous video, we discussed about the Basel III norms and how they help in safeguarding the sanctity of our financial system, especially the banking system. So, if those parameters are breached by banks and if RBI finds out that a specific bank is not functioning according to this Basel norms, what happens? So, this is the question. So, a framework called the Prompt Corrective Action Plan, which RBI introduced in 2002, that will come into action. Now, why are we reading this? What is the latest update? So, recently, that is around 5th November 2021, RBI decided that we have to implement new standards for this prompt corrective action plan. So, what does this mean? Let me explain in detail. Firstly, as the name itself indicates, it's a corrective plan. So, if RBI finds that a specific bank or a non banking financial company is not functioning in a way that is good for the financial health of our economy or for that particular bank, it will create a trigger or an action plan or a set of strict regulations that that bank and NBFCs should follow. However, you have to remember this exceptions which can be asked in prelims. This prompt corrective action plan is not applicable for housing financial companies, those NBFCs which do not accept deposits, government companies, and finally, primary dealers. Now, what do you mean by primary dealers? These are the financial institutions that can directly deal with the government securities directly with the government. So, when was this reviewed last time? It was reviewed in 2017 by the Financial Stability and Development Council and the Financial Sector Legislative Reforms Commission. Now, I want you to comment in the comment section below what do you mean by this FSDC. If you are not aware of the answer, I'll explain in subsequent videos, but do comment about your knowledge of FSDC. Now, what is the objective of this PCA framework? Firstly, obviously, it will help us in understanding that there are non-performing assets in the system and it can impact the financial health of our economy. Secondly, RBI is a regulator, and as a regulator, its job to alert all the stakeholders. That is, it can alert the investors in a company, it can alert those who are taking loans from that company, or it can even alert the depositors that something is wrong with this company's functioning. So we are kind of imposing a regulation. This will have a overall good impact on the financial health of the entire ecosystem, and that is why PCA framework is the first step to avoid non-performing assets, further non-performing assets. So what are the parameters that RBI uses? These can be the parameters. Now there can be a question in the prelims examination saying that which of the following are not a part of the parameters taken by RBI for PCA framework. Or it can even ask what each of these terms mean. We have discussed what each of these parameters mean in the previous video. Now, as far as the latest regulation is concerned, you have to note this exception because prelims examination will have questions on exceptions. In the recent guidelines released by RBI, this parameter is no longer treated as an indicator for putting a bank under this PCA framework, that is return on assets. In simple words, you can say that return on assets is a financial ratio that indicates how profitable a company when you compare it with the total assets it has. So you don't have to go into the depths of this because RBI has exempted this. So you know that capital is all about the capital adequacy ratio, which we have discussed. Asset quality is nothing but the percentage of NPRs, and when we're talking about leverage ratio, we are talking about how much tier 1 capital is present with the bank. We have discussed this tier 1, additional tier 1 and tier 2 capital in the previous video. If you don't know that, please go back and watch it. Now, when is a bank placed under this framework? So usually for every quarter, there will be some audits within the companies. Even banks are companies, so they will also have audits. And when this audited financial results are out, and apart from that, RBI will carry out its own service. Assessment frameworks will be present with RBI, and they will be doing their regular assessments. So, in these surveys and the audited financial results, if RBI finds out that the parameters discussed here are breaching certain thresholds, then a bank will enter into the PCA framework imposed by RBI. If the bank wants to exit this PCA continuously for these three parameters, 4 quarters of performance must be exhibited by the bank or the NBFC. Here again, you have to remember the intensity of the strictness or the intensity of the regulation depends on something called the threshold level. Now, it is not important to remember at what threshold what happens, because it is too specific. But just remember that there are certain thresholds according to which the strictness of uh, the regulation happens. Now, there are three thresholds. When the first threshold is breached, it is the least strictest action taken by RBI when a bank is placed under PCA framework. So RBI can take certain discretionary decisions, but primarily the banks would be advised to generate more capital from whatsoever resources. Now, when the second level is breached, apart from all the directives given by RBI in level 1, the banks would also have to go for higher provisioning, and there will be a severe restriction on branch expansion. It makes sense, because when you don't have the capital to run the existing branches, how can they open new branches? So there will be strict regulation from RBI on this front. Now, if the third level is also breached, apart from whatever is taken in level 1 and level 2, there will be a strict imposition of caps on the salaries of higher level management, so that they are held accountable for all the bad decisions they have taken. So this is also a part of the PCA framework. Also, you have to know that for urban cooperative banks, just like the prompt corrective action framework, RBI has rolled out the supervisory action framework. So this was introduced in 2012, and further regulations were tightened in 2014, and in the context of the pandemic again in 2020. The specific details are not really important for this UPSC examination. So what is the takeaway? You have to remember that PCA is only for commercial banks and NBFCs, but when we are talking about the urban cooperative banks, it is the supervisory action framework. Now let us understand some important points which are discussed here. So the first question you need to know is, can banks invest in government securities and other highly liquid assets when they are placed under the PCA framework? The answer is yes, they can still apply for government securities. The RBI is basically placing restriction through the prompt corrective action on various banks, because RBI is scared that they might indulge in reckless lending. But when you're investing in government securities, there is a sovereign guarantee, that is, government will definitely give that money back. So it is not a risky lending. So they can definitely invest. Now, a lot of people might be confused about the term leverage ratio. We talked about this when we were discussing the Basel III norms. So basically, the Basel III norms specify that the central bank should ensure that all the banks have a leverage ratio of 3%. Now, what is this leverage ratio? We talked about the tier 1 capital. It consists of both equity as well as debt as a percentage of total assets, or as a ratio of total assets. Now, when we say that the 3% ratio should be maintained, it means that more and more capital is expected to be retained with bank. Now, normally, if we have a higher leverage ratio, leverage means we are actually borrowing to make that as a capital in a hope that we will generate good returns on the business. So having a high leverage ratio means that the banks are having a high risk. So basically, when you're taking more and more debt from people, it means that there is a lot of liability with the bank. So usually, higher leverage ratio, higher leverage ratio is considered to be a bad sign for a company, because that company is borrowing more rather than using its own profits. However, Basel III committee still recommends that we have a percentage of 3% or more leverage ratio, because it gives the capital. Now, capital is giving the security to the financial system. Even though it is debt and we are taking more and more loans to build capital for the banks, it is still a healthy sign, because banks can reinvest that and generate higher returns. So that is why Basel III committee is recommending a higher leverage ratio, despite the fact that it is not considered to be healthy in normal terms. For a normal company, that is non-banking companies or companies which are not involved in rotating money, a higher leverage ratio means it is borrowing more than what it can actually reinvest through its profits, or it is not making a proper business. So remember this point. Don't get confused when we're talking about leverage ratio. Generally, a higher leverage is not a healthy sign, but for banks, as recommended by the Basel III committee, capital is even more important than the debt, because we can eventually, if capital is there, lend more and ensure that repayment is done to the investors. So these are the important points that we have to understand with respect to the concept of prompt corrective action. And since we have completed all the important prerequisites, in the next video, I'll be uploading about the insolvency bankruptcy code and the concept of bad bank. If you like this video, please like, share, and subscribe. And at the same time, you will be able to find this PDF from the Telegram channel, the link for which would be placed in the description box below. That's it for now. Thank you.